Okay, so I think we should get started. Welcome everybody to this second day of the Paris School of Economics macro meeting. This day is sponsored by the Banque de France, which is the partnership by which the bank allows us here at PSE to host a number of events and research activities in macroeconomics. I thought yesterday's program was super interesting, but I'm also really looking forward to today's program, which I think has a number of exciting talks. And I think I'm allowed to say that because I have contributed literally nothing to preparing it. That I think has been done entirely by Francesco. In fact, I have only very recently taken over from Agnès Benassi to help with the chair's activities, together with Francesco here at PSE, but also together with Olivier Bandt and Julia Schmidt at the bank. Now, I did talk, remembering about January, I think it was, to Agnès and Francesco, where they told me what theme they had chosen for the conference, sovereign default, but little did we know at the time that it would become so topical only half a year later. And that's, of course, because of the COVID-19 crisis, which has led to an unprecedented worldwide recession at the same time as it has increased public spending needs, thus causing a large jump in debt to GDP ratios around the world. In fact, I think the IMF forecast advanced economy debt to be about 130% of annual GDP at the end of this year. I think is unprecedented. Now, so far, we haven't seen much effect of that on refinancing costs, but as Giancarlo in his talk this afternoon will tell us, it is at those debt levels that countries become susceptible to self-fulfilling debt crises. Now, as usual, I'm tempted to say it is not the advanced economies, but the other economies in the world that are particularly hard hit by the COVID shock, among them emerging economies. And in fact, we've seen already 3 of them default this year: Argentina, Ecuador, and Lebanon, I count, but you may be correct. You may add another one. I don't know if I counted them all. Now, as commodity prices have fallen during the recession and financial conditions have tightened, particularly in the first part of the year, those countries have faced and are facing very tough choices. In particular, they need to trade off the health of their citizens by locking down and economic activity, which allows them eventually to pay back or continue paying back their external debt. And it's exactly that policy trade-off that is at the heart of Cristina Arellano's keynote speech tonight, which I'm really looking forward to. Now, one of the policy options that Cristina will talk about is debt relief. And I'm happy that we've seen important progress along this dimension, if only for low-income countries and only for official debt in the form of the G20 debt standstill agreement signed earlier in April this year. And again, this only concerns official lending, but as Christoph Trebesch in the first talk in a couple of minutes will tell us, that's actually an important component of lending and has been throughout history and is particularly important for some countries and during crises. There has been, after the COVID shock, a lot of research on its distributional consequences and the distributional consequences of the policies that were taken. And we've seen Ben Moore present yesterday a very interesting paper that talked about this. That reflects partly a general movement in macroeconomics where issues of inequality and heterogeneity have been incorporated in our models ever more. And I think the talk by Pablo de Erasmo after the coffee break today is actually a nice example for this, because it looks at the costs of sovereign default for domestic households that have to use government debt to ensure idiosyncratic income risks and the effects that has on government incentives to default. The final paper in the set this afternoon is that by Facundo Pibre-Yem and co-authors about fiscal rules versus discretion when governments can default on their debt. I have to say, I haven't seen the paper. It's very fresh, so all the more I'm looking forward to talk. An interesting program, therefore, I think, and let me thank again Francesco, who will also act as the chair for the program this afternoon. Now, with this online format, the time window of decent hours in the US and Europe is a little bit short. So we don't have a policy panel as we did in last year's, but we will surely come back to the issue of sovereign debt from a policy viewpoint and from an academic viewpoint in the future. So I hope to see many of you for the future events of the Banque de France at the Paris School of Economics, hopefully at some point also in person again. But let me now hand the floor, the virtual floor, the Zoom floor to Olivier de Banque, who wants to greet you from the Banque de France side before Francesco is going to take over to chair the program this afternoon.
Okay, thank you, Tobias, for just on my side, on behalf of Bank of France. It's a pleasure to welcome you to the annual conference of the Banque de France Paris School of Economics chair. And we look forward to this excellent set of contributions by leading academic experts in the field, and as highlighted by Tobias. Tobias, expressed the high relevance from the policy side of the issue, which has never been so high. Actually, the relevance of the issue also was signaled by Ken Rogoff and Carmen Reinhardt, together with Christoph Trebesch, who is the first speaker, which indicated that the COVID-19 was created an urgent need to improve debt restructurings, which are, in their view, likely to be in numbers never seen since the 1980s. So we're going to have a major crisis, in expectation. Tobias mentioned that there was a tremendous increase in public debt, and we see there are elements showing that these issues are currently addressed. Some borrowers find financing for multilateral organizations like the IMF. There is also the Paris Club restructuring mechanism, and there was also, as mentioned, a strong multilateral response to the crisis, in particular through debt moratorium. It is the DSSI, the Debt Service Suspension Initiative, which for low-income countries. And this is a major initiative, in particular, since we see that already at the end of August, 43 countries were participating in the DSSI, which represents 60% of the eligible countries, or 75% of the eligible official bilateral debt service from May to December. So the big chunk is being covered by this DSSI. However, this mechanism may not suffice. In particular, the COVID-19 may create the COVID crisis may create a systemic crisis and a debt overhang, depending, of course, of the length and the scope of the virus. We don't know yet how it will evolve, but there is a major risk that this may become very tricky. So debt crisis in general represent an opportunities to improve the international financial architecture to facilitate debt resolution, and there is a need certainly for more effective and comprehensive international coordination, because there is many borrowers many creditors are involved there, so there is a need for international coordination, which has been mentioned by the G20. Also, as noted by Tobias, private sector participation is key, as it is increasing. And we saw that in some cases, actually, private sector is actually public banks, which are very active in this area. And also, other dimension, this creates a need for more transparency of the debt level in order to deal better with this phenomenon. And other proposals have been made in the past, which in particular Anne Kruger's proposal for sovereign debt restructuring mechanism, and there are also proposals by UNCTAD for an international developing country debt authority, but all these proposals so far have not yet are acceptable by borrowing countries as well as creditors. So there is a lot of initiative proposals in the field, and I hope participants will have the opportunity to discuss and to address some of these issues during the talk and the afternoon. But I'm pretty sure, in any case, that we're going to have very lively exchanges on these issues. And thanks again for being with us today and to share your thoughts about these issues. Thank you.
Okay.
So I give the floor to Francesco, who is chairing the session.
Yes, thank you, Tobias and Olivier, for your words. So I think we can get started. So the rules of the conference for those that have been there yesterday are just the same. So each speaker has about 50 minutes for their talk, and the audience can ask clarification questions using the chat, and I will pass them to the speakers, and then in the last 10 minutes we open the mic for open discussion. So I think it's time to get started because we are two. So the first speaker is Christoph Trebesch, who's going to talk about coping with disasters, 2 centuries of international official lending. So Christoph, the floor is yours.
So thank you very much. Let me try to share the screen here. 1 second. Where is the okay, there you go. Here. Okay. Can everybody see this?
Yes.
Okay. So thank you very much for the kind invitation and for allowing us to present our work here with this, which is joined with Sebastian Horn and Carmen Reinhardt. All views here are personal, and the motivation of the topic of this paper is very much related to what Olivier de Bandt said in his introduction. So it is a paper about the international response to a major crisis, to disasters. How does financial cooperation actually look like, and particularly cooperation via this international lending or bailouts, if you want, not just in financial crisis, but more generally in disasters. So we are interested in the international financial response to disasters such as financial crisis, but also wars and natural catastrophes, such as pandemics or volcano eruptions, earthquakes, etc. In particular, we're interested in this response via official lending. Okay, by official lending, I mean not just IMF and World Bank lending, which is what we typically think of, but more broadly, government-to-government financial flows. So lending between 2 governments of independent states, lending between 2 central banks across borders, and of course, international multilateral lending. So think of this as an analysis, as a broad-based analysis of state-driven lending in disaster situations like the current one. In fact, when we started this project 5 years ago, we didn't expect the next major disaster to occur so quickly. So let me therefore motivate the paper with a graph on the COVID disaster. Okay, what you can see here is the drastic collapse in international capital flows in the wake of the COVID pandemic outbreak. This is data from the IMF capturing net debt and equity purchases to 32 with regard to 32 emerging markets. So this can be seen as a proxy for portfolio flows as captured in the balance of payments. And what you can see is that cumulatively, within a matter of just 3 months, there was an outflow of more than $200 billion out of emerging markets in this very short period of time, making it one of the major sudden stop events of recent decades. And you all know that these type of sudden stop events have been broadly studied in the literature. There's a large body of work on risk sharing via private capital markets, typically concluding that risk sharing is limited due to the pro-cyclical nature of private capital flows. What is much less known and the counterpart, the other side of the coin to the sudden stop, is the sudden spike in official flows. This is a much less studied phenomenon in the context of international capital flows. What you can see here is the cumulative commitments by the International Monetary Fund, the World Bank, as well as importantly, all these regional financial arrangements like European Investment Bank, African Development Bank, etc. So think of these regional safety net arrangements. And what you can see is that cumulatively, the official response has approached 150 billion as of May 2020, and these amounts have continued to rise and are likely to rise further, as we've heard from the introduction. And this figure does not even include bilateral debt or debts by central banks. We know that the Fed has initiated large-scale swap line arrangements of considerable size. These are not yet in there. The reason they are not yet in there is that this type of data is very messy to collect. This red line took us basically 2 hours to plot. These blue shaded and gray shaded areas took us a couple of weeks to collect the data. In fact, it is surprising, given the size of this, that there is no systematic data collection on official capital flows in a broad sense. It's easy to get the IMF flows separately if you look for them for a while. It's easy to get the World Bank flows, but like a broad-based picture on the official capital flow does not exist, or at least not in a systematic form. And this was the central motivation for this paper. There are large amounts of official cross-border flows that have not been studied sufficiently. There is an extensive literature on private cross-border flows, to which many of you have contributed. There is also literature on official flows. Giancarlo has contributed on this with co-authors, Aitor and others on the Euro crisis, so official debt in the Euro crisis. There's work by Alfaro and Camille Okcan and co-authors looking at developing country official debt. There is work on catalytic finance, again with Giancarlo and others. But typically these papers have a narrower time span and focus on either one institution, one type of crisis, or one type of countries. And what is missing is a big picture encompassing analysis of official capital flows at large. And this is what this paper tries to do. We gathered a database that we then exploit across 200 years, looking at official lending, or if you want, you can call it international financial cooperation via lending in a broad sense. So we cover loans, grants, and guarantees by governments, multilateral institutions, and central banks across borders. The data set, most of the graphs I will show are aggregate time series, but the data set itself is actually granular. So it builds on 230,000 individual grants and loan entries by more than 100 governments and more than 50 international institutions. In total, what is the size of this? Well, 50 trillion real US dollar in 2015 terms. That's about the size, that's a cumulative commitment. That's about the outstanding stock of US traded public debt in 2010. So these are large amounts. In terms of where did we get these sources from? Well, there was a long and painful process, including traditional sources. For example, we got access to proprietary World Bank data from the debtor reporting system. So they collect this data on official lending, and we got it on a bilateral dyadic level. That was extremely helpful from the 1960s, 70s onwards. We also use OECD data. But looking further than the 1980s required other less traditional sources. In fact, some of them rather obscure. So we gathered creditor and debtor budget accounts. We made use of the fact that diplomacy in the late 18th century became more and more formalized, and all these interactions became were written down in treaties, right? So all these lending arrangements eventually had a kind of a contract, a treaty between governments that they built on. So we gather all these contracts, all these treaties to puzzle together this database. Then we draw on dozens and hundreds of additional country-specific sources, and then combine all these different pieces of information into a consensus database where we cross-check across sources and consolidate it into this bigger consistent database. Just an overview, what are the creditors we are looking at? Well, traditionally, it's bilateral creditors. So this is central banks and treasuries, but also foreign colonial offices. Then you have export credit banks joining the club of bilateral lenders. And importantly, from World War I on, you have an emergence of all these multilateral institutions, like League of Nations, BIS, of course, the Bretton Woods institution, but very importantly in recent decades, also regional financial safety nets, like the ESM, of course, that Giancarlo has studied, and other regional funds like the Arab Monetary Fund or Latin American schemes on a regional level. And these are, as I said, typically called the international financial safety net in a broad sense. From all these institutions, we gathered details on the lending amounts, right? That's the key focus today, but wherever we could, we also gather details on the terms, so interest rate, maturity, and where, if we can, also strings attached, so conditionality, etc. There, it was hard to get a complete picture, but we are still working on those aspects, and likely we'll use that in future work. We're currently trying to gather more information on the interest rates, also from on the last decades. So that is very much work in progress, but have finalized this clear overview of amounts. Yeah, Christian.
Can I ask a question? Don't governments sometimes try to keep these things secret? Who they lend to and at what term?
Not only sometimes, I would say it's rather systematic. There is it is typical. This game of saying that you will never bail out any government and never forgive any debt, and then you do it nevertheless again and again, is 200 years old, right? It's always the same. So there's like kind of a exposed, the bailout happens ex ante. There's kind of unwillingness to share too much information, also exposed. So that's why we did this project, right? So for the private markets, you have Bloomberg and all these other financial service data providers that cater to Wall Street, and as a byproduct, we can benefit from it. But there is nobody doing the same for governments, I mean, the fact that we had to get proprietary access from the debtor reporting system, and that these things, the bilateral lending flows, are not public, is already somewhat stunning, right? I mean, this is public debt.
I guess another way of asking my question is, are you sure you don't miss a big chunk?
Okay, sure. We are, I mean, again, this project took 5 years. And we dug very deep, but of course we will certainly have missed loans and bonds, so almost with certainty. But I can tell you the same for the private. If you go to Bloomberg and download all existing outstanding bonds, good luck with that. I mean, it takes 2 years to clean, and you will have plenty of false entries there as well. So we didn't have a clear benchmark like Bloomberg or other data sets, but in a sense, like it's not that measurement error. This type of measurement error is not confined to official finance. Well, granted, of course, the likelihood we'll miss more because less people have worked on it is higher, but we're pretty confident, given that we cross-checked across multiple sources. So we rarely have only one source on these entries. And we really benefit from the fact that the government, in some form or the other, has to report on it, right? Either in its budget accounts or in these treaties. So wherever we could, and I'll show you, sources where even in the most. Let me skip straight to that. So one of the sources we use is, for example, on Soviet loans within the communist bloc, right? One would think we have no way to find that out. Well, fortunately, the CIA meticulously collected all the loans flowing between, Cuba and these other Soviet or communist states at the time. So that was a very important source for the post-World War II era. And so basically, we tried to address the problem you raised the best we could, and in a most complete way we could. And we do have this benchmark also with World Bank and other aggregate for sub-periods. So, but of course, I mean, this is no way this is a 100% census, right? That is not what we're claiming, but is, I think, quite a step from where we started from. This perspective. On the historical budget accounts, we have sources like this one from Great Britain. You see the outstanding amounts to, for example, Portugal, Russia, Bavaria, etc. And then we can cross-check that with the treaties we gathered or other country-specific sources, right? So that gives some assurance that we're not completely off and that we're not relying on individual, possibly politicized reports, but really try to merge all this information together. Besides this lending database, and there's a long appendix if you're interested in the details of how we did it and where the sources come from, we really list all our sources in great detail. Besides this official lending database, we also created a data set of disasters, again using more traditional and less traditional sources. So financial crisis, we use Reinhard and Rogoff, the usual banking, currency, and sovereign debt crisis. Some of that updated until recently. Then for wars, we used the Correlates of War project, internal wars, external wars. For natural catastrophes, there's this MDAT database that some of you will have used already, but that ends in 1900. So for the 19th century, we again started our own data collection, drawing on dozens of sources on major disasters like earthquakes, storms, and floods. So again, the details of that are in the appendix, but that's the takeaway is financial crisis, wars, and major natural catastrophes is the key focus here. So before I delve into the more detailed results, let me take a step back and say, so what are the central research questions we are after? Why do we collect all this data, and what are the key insights? So the first obvious question is, how big is this? Is this relevant? Is this just like a side fiddle to private capital flows? Basically, we view it through the lens of this catalytic finance, basically privates playing the key role, but officials only stepping in very rare instances? Or is this actually a big part of the international financial system? And our conclusion there is that it is surprisingly large. At least it was surprising to us from our priors. It's in fact the amount of official loans is in fact larger than private flows in various points in time, especially in disaster situations. What we do, however, find so official finance is old. It's a 200-year phenomenon, so it's nothing related to the IMF or the World Bank specifically, right? We have to think much bigger than that, or we have to think as World Bank and the IMF as kind of a new kind of institution in this bigger history of official lending and bailout lending. But it has indeed become more institutionalized, right? These institutions, like the Bretton Woods system, has and the rise of the regional financial assistance programs have made this a much more systemic, regular type of international capital flow. And we find, so in the 19th century, it's much more crisis and country specific, whereas today we see a very regular official lending flow. So put differently, in the 19th century, you had a globalization in trade and private finance, but not so much a globalization of financial official assistance, okay, which we see today. So that is we thought very, very interesting to see, how today we have international official lending has become such a big part of the system. the second key stylized fact we present is that there is a interesting interaction between private and official flows. So the graph I showed at the beginning, that whenever private flows retrench, as during the COVID crisis, then official lending steps in, right? This inverse relationship that can be found in a variety of historical sub-episodes and crises. So this pattern that private capital flows tend to be pro-cyclical and official flows tend to be counter-cyclical can be clearly seen in the data over the past 200 years, and is we think an important takeaway from this paper. So earlier papers have looked at that individual episode. We really find that this is a if you want, a characteristic of the system at large. Then we look at the patterns of lending. So who gets what and why? So why do governments actually lend? And who are the ones receiving this official lending? And to shed light on these big questions, we provide a first step. So we see this not more as a first step in a broader agenda. And in this paper, what we do is really bring some of the more influential papers on the topic to the data. So Tirol and Gorinchas et al. They look at country rescues and bailouts and predict that trade and financial integration should matter. So you're more likely to bail out a country that has strong economic exposure, to which you have strong economic exposure. So if you're closely linked economically and in terms of trade, bailouts will increase. And indeed, we can confirm this prior very clearly in the data, both on the extensive and intensive margins. So both the occurrence of bailouts is higher in countries you are closely connected with, and the size of these bailouts grows with the degree of exposure. Whether that in the end is kind of a selfish motive in the sense that you're trying to limit your own, the collateral damage from the neighboring country that is in a crisis, or whether it is more an altruistic motive in the sense of helping your trading and partners and friends, is a matter of interpretation. But we can certainly see that, official flows follow this economic exposure integration. So let me, if there are no questions.
Sorry, Christoph.
Yeah.
Can I just ask a question? Are you going to explore also the role for the expansion of central bank balance sheet on this? Like when you talk about official lending, and the increase in official lending is always through what you call the multilateral creditors, or also the fact that the intervention of central banks are much more faster and they are much more large today than in the past?
So yeah, very good question. I mean, we try to focus here on lending in a classic sense, on crisis lending, disaster lending in a classic sense, meaning proper loan contracts or bond contracts written between governments or via these regional and multilateral institutions. Reserve accumulation per se, portfolio purchases are a different animal from that. And we do have all the data, so we could add it easily. But I think in terms of conceptually, it makes more sense to look at central bank lending, and we do that. In fact, we have a central bank component in our analysis by looking at swap lines and credits extended between central banks. So that is more of a traditional crisis type arrangement. That is a central part of the analysis. It is a somewhat different concept as well, because it's collateralized oftentimes. It is and can be related to these currency management aspects, but nevertheless, portfolio purchases per se are not a central part, because it is not typically part of the Fed buying European bonds is not the typical crisis channel, crisis rescue channel. It's rather that the Fed would extend dollar liquidity to the ECB.
Yeah. Okay.
So let me show you some of the central graphs from our analysis. This is one of them. What you can see here is the total aggregate official commitments, so gross flows, if you want, by official creditors, both bilateral, which is the blue shaded area, and multilateral, so think World Bank, regional, and IMF. which is red. And what you can see, and we scale this as percent of center country GDP. So this is UK GDP until World War One, and after 1914, it is US GDP. The graph looks very similar if we scale it by world GDP, but world GDP in the 19th century is a much more messy estimate than UK GDP. There's a whole industry of historical researchers measuring, UK GDP properly. Whereas if you use the medicine data, which is in real terms and needs adjustments, and you look at world GDP, it becomes noisy. So therefore we prefer to show this as a share of UK and US GDP. And again, the big picture doesn't change much if we do it otherwise. This said, what we can see is that lending amounts are much, or the official lending in the 19th century is substantial, 1 to 2% of UK GDP in certain years, but much more spiky than today, right? You see during the various crises and in particular during the wars, you see these spikes, and of course most impressively you see two major spikes during World War One and World War Two. So compare, just to put this in perspective, this spike means that during World War One, official creditors extended more than 10% of US GDP per year in new lending across borders. That is a staggering amount that puts into puts the already very large amounts granted in the great financial crisis after 2008 into perspective. So this is enormous transfers that have taken place during the world wars, and just show you how disruptive a global war is for the international financial system. So the amounts here, of course, much of this is military aid, but still replacing private flows basically in these eras. But just the amounts of these are staggering. You can clearly see that's another pattern, a shift from bilateral to multilateral that we're mentioning before already. And of course, the third major spike in official lending was in 2008, after 2008, and we were likely to see a similar spike in the wake of this ongoing corona crisis. The amounts, of course, after World War II on average have been higher, right? So this is what I meant by systematic over. Just to emphasize how important, so this is a similar plot, but shown differentiating by regional, IMF and World Bank, and bilateral. So, and this is from the 19th century to 2010, before we had the full 200-year picture. And what you can see is that bilateral lending was the main game in town in the first part of the 19th century. And then you have the IMF really taking over dominantly, and the World Bank from the 1970s on. And more recently, it's really regional financial arrangements that play a ever more dominant role. But also you had this re-emergence of official lending, partly driven by China. In fact, this does not include the hidden parts of Chinese lending, so the unreported parts of Chinese lending. We have a separate paper on China, if you're interested in that aspect. So you see, but this rise of regional institutions really shows you how important also emerging markets or south-to-south lending has become in recent decades. In fact, it's also the number of papers, of rigorous papers on these regional arrangements is also quite limited. So,
ask a stupid question. This is all based on annual flows.
This is all issuance. Yes, this is issuance of commitments of official debt in that specific year. Yes. So think of it as gross flows. Yes. Now, to your question, Pappadà, Francesco, sorry, I was reading the big Pappadà. So, to your question, Francesco, on central banks. So yes, it is a big, important part of the picture. In fact, I think there's much way too little work on central bank lending across borders that doesn't take the form of portfolio flow. So there's a big literature on all these reserve holdings, right? But there's much smaller literature on swap lines. The only one working on this is Ricardo Reis and his co-author. Sorry, I forgot the name. I think we need much more work on that. What we do here is really gather the amounts of central bank swap lines, which is relevant from the 1960s onwards. So again, swap lines are not a new invention of the 2008 crisis. They also have been heavily used in the 60s. Bank of France researchers will know this very well. The 60s, 70s, 2000s. But of course, the scale of the 2008 central bank treasury swap lines was stunning. $800 billion US. It's outstanding at some point in time. So this is as percent of US GDP. Again, US and UK GDP, more than 3% of US GDP in 2008. That's quite an amount. Again, this is somewhat of a different. This is collateralized, so it's not exactly the same as this bilateral lending, but it's nevertheless conceptually much closer than portfolio flows. What we found out as part of this coding exercise was just how large the rescue operation during the interwar gold standards were. So this is the early 1930s, when short-term credits, typically 3 months credits with actually some substantial interest rates, were arranged to crisis countries of Germany, crisis central banks of Germany, Austria, Britain, etc. So these were kind of groups of central banks bailing out other central banks, if you want. Eventually, to no avail, the gold standard did not survive, but the amounts that were channeled at this time were quite large, even in today's when compared to the 2008 crisis. When we add these central bank swap lines, these central bank to central bank credits to the previous picture of official loans, so bilateral, multilateral, and now the new component in this graph is the red share, which is the central bank swaps and credits. The big picture does not change so much. Besides that, the big spike in the 1930s. So if you are a scholar of the Great Depression and you ignore central bank credits, you miss a big part of the picture. In fact, Eichengreen, Eichengreen's book is all about that, Golden Fetters. This can be clearly seen here. And of course, also you miss a big part of the action in 2008 if you ignore that part of the story. But the overall picture does not change so much. Let me move to the second key takeaway, which is that private capital flows tend to be pro-cyclical and official credit tends to be counter-cyclical. Let me just advertise that Sebastian Horn, one of the courses, has a paper, his future job market paper, will be looking very specifically at the consumption smoothing or the risk sharing effects of this, right? So he will compare the risk-sharing properties of official lending to private lending. And then also within the official category, risk-sharing via the IMF, via regional, and via bilateral means, right? So what's better? If we want to rescue a country in a crisis, should we go multilaterally, should we go regionally, or should we go bilaterally? I think that's a very fundamental question that has not really been answered. And he does that in his paper using the data set we have here. And I'm pushing him to put it out, but he's improving.
Christoph,
yeah,
this is Pablo. I have a question. So, like, is there any information on the pricing? I guess even within this official capital flows or debt flows, I imagine that during the crisis, the pricing of a swap is very different from a loan from an IMF. So do you have any information on that? In order to kind of analyze kind of the free sharing agreements, I guess,
yes.
Even if
I understand.
Private and
yeah, I understand the direction of this question. I think it's a very, very valid and important point. So we can't really evaluate the risk sharing properties if we don't know how large a subsidy in effect is in official lending and whether how much below market rates these flows would be. Quite likely it is the subsidy is high because most countries simply lost access. There is no market price anymore in the private market. But we do have, yes, so the short answer is yes, we do have information on the interest rates and on the terms of these loans for a big part of the sample, particularly the historical part. We are currently trying to get data on the modern part. So what are the interest rate characteristics of official lending, of bilateral lending in the last decades? I think there's a paper to be written on exactly this point. So how large the subsidy is systematically and how it evolved over time. From what we see in the data, in the 19th century, the terms were less concessional than they are today. So it seems that both the amounts were large in the 19th century and the terms were were smaller. Sorry. So it was less systematic, smaller amounts in the 19th century, and the terms were less favorable for the crisis country. So the subsidy seems to have increased, and understanding, the drivers of this and the macro effects of this, I think, is a very important next step in this agenda. I hope I answered the question more or less. Yeah. Okay.
Yes. Thank you.
All right. So let me move to the second, key takeaway, which is this pro-cyclical versus counter-cyclical movement that I already talked about. What you can see here is the big 200-year graph on this issue. The gray shaded area is, again, the official commitments, including central banks. What is new in this graph is the red line. The red line comes from a paper by Vincent Reinhardt, Carmen Reinhardt, and myself, where we construct a long-run database of private international capital flows. This is a combination of gross flows. So this is issuance in mainly in London, but also other international capital markets in the 19th century across borders, again scaled by UK and US GDP. And then from World War I onwards, we constructed a data set of net flows using current account data, reserves data. So we do have all this reserves data. Then to construct, measures of capital flows basically for all the major countries from 1914 onwards. And then we combine this series of gross and net flows. So one should be wary that this is not a one-to-one mapping here. But nevertheless, the patterns are notable. What you can see is that the basic takeaway is that indeed, when you see a collapse in private flows, you do see, this is the Bearing crisis, you have the famous collapse there. At the same time, you see the spike in official flows. The same occurs during World War I, where you have basically a complete replacement of private finance, private international finance with official international finance. You see the Great Depression, where private, Eichengreen has called this the mother of all sudden stops. You can clearly see this drastic collapse in capital flows to the periphery. And at the same time, you see this large spike in official flows. Then you have here the Bretton Woods era, right, of closed private capital accounts, where basically official lending is the only game in town, right? The 50s and 60s are the era of official finance. Again, we have not fully explored this era and understood the international capital flows. I think much more work needs to be done on that specific era as well, because we are partly moving back to this era of financial repression, and official lending, given the rise of emerging markets, is returning, given the rise of central banks as holders of official debt. State-driven lending is back. So understanding the 50s and 60s seems important from today's perspective. You can also see, of course, the collapse in capital flows in the 2008 crisis. The overcorrelation is 0.36 negative. Of course, as I said, this is a mix of gross and net flow series. So what we wanted to do, it's not in the paper yet, but we've done it in the last weeks and months, is to have a proper apples-to-apples comparison of gross to gross. Okay, so I'll now show you case studies of gross issuance by private, the private international markets, and gross issuance by international official lending. And this is just one of the case studies here. This is the interwar and the Great Depression. This is absolute amount, so not scaled by GDP, because GDP data for many of these countries in this era is not precise. The same problem as before. So these are gross amounts. what you can see as a red line is this League of Nations data on private international gross issuance. Okay, so this is basically bonds issued by public and private entities in international markets, and you can see the well-known story of the roaring 20s, so the capital flow boom of the 20s, mainly driven by U.S. money flowing into Europe. Then you have the collapse in the Great Depression already in 1929, and even more starkly after 1930s. What is less known, and what is the contribution here, is the bars, which are official lending. So there was substantial official reconstruction and relief lending after World War I. These are the dark gray bars. And as I pointed out before, substantial central bank lending, central bank to central bank lending in the early 1930s. So we can clearly see this pattern, this inverse relationship of official and private flows in this era. The same is true for the Eurozone crisis. It is a bit trickier to define what is external issuance in the Eurozone context, because you have the euro. In principle, any debt you're issuing is in a way foreign. But here we follow the BIS definition, which looks at the marketplace and the governing law in which the bonds are issued. Again, we look at public and private borrowing, importantly, in the same set of countries. So this focuses on Greece, Ireland, and Portugal, as well as Spain. So the GIPS with one eye. And now we scale by creditor GDP, by debtor GDP, okay? And what you can see is the red line is that you see the stark capital inflow boom in the southern Eurozone periphery. So we're talking about, an increase by almost 20 percentage points to GDP in terms of external issuance on a yearly level. This is, again, gross annual flows. And you see the well-known official lending flows, which is the IMF and ESM, EFSF, so the Eurozone bailouts that in terms of size, are similar. And again, and that's the key takeaway, is you see this counter-cyclical pattern. We have similar graphs for the Asian crisis and other historical events, but I'll move on because I guess
May I ask a question on this, please?
Yes, of course.
This is Agnes.
Hello.
Hello. Do you have the central bank lending here? So what I'm wondering is whether the target is the equivalent of the swap lines. And I had in mind that the target flows were as large as the official lending. So it would basically double your bars. And it's very strange because then it would exceed the collapse of the private flows, which is probably not the case. So I'm a bit confused about the scale, but because in my view, the target flows were as large as the official lending.
Yes, I mean, this does not, so on your second part of confusion, this does not capture capital flight, for example, right? I mean, if an Italian or Greek investor would buy a German house, this is not captured by the red line, right? So in terms of, it's not a one-to-one mapping of replacing. One would probably need to look at the balance of payment.
From the balance of payment, this is the case. If you map the balance of payment, for instance, say Greece, and you have the decumulation of private inflows, so the accumulation of private outflows from the balance of payment.
Sure. Yes.
And the counterpart of it is the accumulation of inflows from official lenders on one hand, but on the other hand, the accumulation of target liabilities.
Yes.
And,
so no, I'm fully with you.
The sum of the two is about the.
Exactly. Yes. Yeah. I'm completely in agreement. If you would look at balance of payment data, that is exactly what you would get. This is not what we do here. We look at gross issuance, which is different. This is not net flows. Again, not capital flows will not be captured. The target question is a very good one. To be consistent, it's not in here because conceptually, again, this is not a credit line extended by the ECB. This is not a written contract by the ECB. Now, one could add it, and I think, Carmen, in other work we have added it to, you know, you can count as a type of credit. So one could add it. And indeed, in this case study, we haven't thought of it yet, or we haven't added it yet, to have this apples and apples comparison of gross issuance. But indeed, it's interesting for this Eurozone crisis, we would indeed have pretty granular balance of payment data, and we also have the target data. So what I take away is that you know, it would be interesting to have a similar graph in a different, you know, using other data and including targets. So in that sense, yes, official lending, if you count target as credit, then official lending was even bigger than what it seems to be here. Yes, but it is not yet.
What is interesting with what is interesting with target lending, it is that it's equivalent of automatic stabilizers. You don't need even a decision. It's automatically countercyclical, whereas private flows are pro-cyclical. So I think this is something that is sometimes missed from a monetary union.
Yeah, those are very good points. Yeah. Okay, thanks. So let me move to the last part of my presentation, and I'll probably take less than, I don't know what's the time, but I don't know. Actually, I've already come close to my time. Anyway, let me move to the last part. So why do countries extend rescue loans? One very interesting insight that I already alluded to in the beginning is that the odds, the likelihood of receiving rescue loans in disasters is much higher today than it was in history. What you can see here is the case of natural disasters. So this is just the probability of, if you witness a disaster in a country, what is the probability of receiving international official flows, both loans or grants, in disasters? And this is by era. So in the pre-World War I period, we're talking about the probability of just 10%. And this is in line with historical anecdotes. For example, the Greek potato famine, which we all know. The Irish potato famine in the 1850s, if I'm not mistaken, 1857, if I'm not mistaken. Basically triggered zero international lending or international assistance. Similar, the Persian famine of the 1870s triggered almost no international reaction. Whereas if you think of Haiti's earthquake in 2010, the cumulative aid flows and loans and grants account for 100% of Haiti's pre-disaster GDP, right? So that is a massive difference in size. And in the paper, we list a number of cases of disasters and their international response and the size of this international response. But in this graph, you can clearly see that the odds of receiving disaster lending have increased substantially. So today, in the post-Bretton Woods system, basically the likelihood of receiving international aid from somebody is 100%. Right, so, and this has to be seen. I mean, remember that in the 1870s, 1890s, these are an era of hyperglobalization, right? These are an era of large-scale financial international flows, large-scale international trade flows. So we had this globalization in private finance, in private trade, but we did not have a globalization in international assistance. So, in a way, if you look at through this lens, the world has become more altruistic, or at least more likely to extend these kind of international loans in disaster situation for altruism reasons or selfish ones. But we certainly see a globalization of assistance. So what can we say about the drivers on a country level? And here we use we exploit the dyadic structure of the data and estimate a gravity model, basically using state-of-the-art trade models, where the dependent variable is a rescue loan by credit country J to crisis country I in a disaster episode T. So this is currently a subsample of disasters that we're looking at. We're currently expanding the sample to all years, and then we'll have interaction terms and all that. But given the amount of zeros, that's not easy to accomplish. we're working on that, but for now, it's really a subsample of disasters where we regress the size of these loans bilaterally on the size of bilateral economic exposure captured by bilateral trade shares, which we have back to 1830, thanks to the trade database, and bank loans, bilateral bank exposure, for which we use BIS data that is not available, of course, historically, so we only have 1840. And we add additional, gravity controls like distance, but also political ties, so UN voting and other former colonial relationships to assess other determining factors. And this is importantly, the economic exposure is pre-disaster, right? So this is not the GDP or trade exposures during the disaster, but pre-disaster shares. Just a preliminary look at the data. What you can see here is a scatter plot where each dot represents a bilateral bailout, if you want, lending amount shown here on the vertical axis, and then you have the trade share, so the intensity of bilateral trading relationships on the horizontal axis. And you can see that the basic takeaway is that the closer two economies are linked in terms of trade, the larger the bilateral rescue loans look like if we look at disaster episodes. We get a similar pattern, somewhat less pronounced for banking exposure, and looking at the recent decades, the higher the bilateral banking exposure pre-crisis, the higher the official bailout lending in the crisis. Okay, and these patterns are clearly confirmed.
I have another question. So,
yes.
Because sometimes the official lending is related to a trade contract. So,
sorry?
Sometimes the official lending is triggered when there is an import contract at some point. Mm-hmm. So have you cleaned the data for that?
No, we did not, because I mean, you could in principle start to distinguish. So I think that I think one way to go about this, and we're working on that, is to look at different type of disasters, right? Because they will have trigger different. So these kind of import contracts might be related to aid and more related maybe to natural disaster, whereas this typical bailout lending that we think of in 2008 terms is more related to financial crisis. So we're currently looking at the drivers of these bilateral flows in these buckets of disasters, right? Financial crisis, wars, and natural disasters. But we haven't differentiated between that. In a way, endogenously, I mean, again, if you have close ties, you're more likely to have those import contracts to start with, right? So that would.
I agree, but you could just lag at the measure of bilateral trade, so that you are not.
Okay, I mean, my sense is that this is unlikely to be large enough to bias, the whole picture, because these are we're looking at 200 years here, and the trade amounts are just very, very large, driving the bilateral trade shares. But of course, I mean, there could be some noise entering via that. I'm not sure it's going to change the big picture, but I'll take that away, and I'll think about that type of indigeneity. So the takeaway of this table, and again, I'm close to concluding, is that the trade exposure, so the higher the trade exposure, the higher bilateral rescue lending is going to be. This is what the model predicts. So 1% higher trade exposure is associated with 0.34% more official loans. This is for the full sample. When we split by historical episodes, the size of the coefficient changes somewhat, partly due to the fact that here we also have a lot of zeros, and the system, the estimates become much more stable in the recent 100 years. But it can clearly be confirmed across all eras of the financial system, this relationship, both descriptively and in this estimation setting. And again, both looking at trade linkages and banking linkages. Distance, again, is in line with theoretical predictions. So the farther away two countries are, the smaller, the less likely they are to bail each other out. Political allegiance is positively associated. So joint voting in the UN Assembly is associated with more bilateral lending in a disaster episode, and again, former colonies. So the other, in short, the other control variables, that not all of which we show here, are pretty much in line with standard gravity predictions. So let me conclude. Official lending is a much bigger story than the IMF and the World Bank. You can think of one interesting question is whether the IMF and the World Bank eventually are just kind of a veil of the same drivers that have, that can explain bilateral lending in the 150 years before World War II, right? So is there something special about IMF and World Bank lending in this big picture? I think that's an important question to pursue. One, of course, important factor is just the pooling and the insurance aspect. Just more countries are paying into the IMF and World Bank resources, making this a likely better risk-sharing arrangement. This is at least what Sebastian finds. We do find this inverse relationship between private and official flows again and again in history. And we do see this globalization of financial assistance become much more systematic today. And economic integration is among the strongest and most robust predictors of official lending flows on a bilateral level. So thank you very much for the comments so far, for listening.
Thank you, Christoph. It was a very nice presentation. We discovered a lot of data that we didn't know. So we already had some substantial questions during the talk, but we have still 5 minutes if there are questions. So you can just ask the question live. If there
Can I
are.
ask another question?
Sure.
Do we know how much of this stuff is actually paid back?
Excellent question, and something that would require probably another 2 years of gathering. Just last week, I had a long conference call on exactly this question. So for some periods, we can find that out relatively easy. Doing that very systematically is hard. We have a paper called The Seniority Structure of Sovereign Debt with Mark Wright and Matthias Schlegel, where we go after this question. So we look at kind of the pecking order of sovereign debt repayments, of external debt repayments. So when you enter a crisis, and this is pretty relevant in this ongoing crisis as well, are you paying back the officials or are you paying back the privates first? And then within the official, is the IMF more senior or the bilaterals? And what we find is that the bilaterals are rather junior. In fact, they seem to be more junior than the private bonds and the private bank lending is, both in terms of, if you look at actual flows and arrears, so late payments, and haircuts. So we have haircuts of official debt and haircuts of private debt. So that paper suggests that far from all of this is paid back. It would be wonderful to write a bigger picture, to write a bigger paper on implicit transfers. So basically, kind of this would add to this agenda on trying to understand the subsidy element of this. So what are the actual transfers? Gorinchas in his paper, they compute transfers for the Eurozone crisis. Doing that for 200 years is a nightmare, but something that might be a nightmare worth going after.
Thanks.
Olivier de Bandt.
Yeah, please.
I have a question. I think I'm interested by your paper. It's a great paper. I have a questions regarding in the you sometimes mentioned the amount of lending. I was wondering, do you need to take into account for in case of a natural disaster, the size of the event and the likelihood of being, the size of the, do you need to take into account that in some cases, I agree that international intervention was bigger, but to what extent does it cover a larger share of the cost? So in the end, should you take into account, for instance, explain variable by divided by GDP of the country, the receiving country, or the lending country? Would it be? I think I would take this into account in order to take into account the fact that is the you may provide an assistance, but it depends of the size of the assistance.
Yes, I mean both. I think the size of the disaster itself is relevant, and the size of the flows in terms of recipient country. Yes, I fully agree. In the paper, we have a list of exactly that. So we list both how large these events are in terms of, you know, we do account for size, but indeed we could try to do the same in the regressions. So that's an interesting point.
I mean, would it reinforce? I mean, I think it would reinforce your study. I mean, because you mentioned the probability. It was we had a chart on that showing the probability has increased, but you don't know how much this increase was. Does it cover a larger share of the cost?
I get what you say. So the size in terms of credit GDP has also increased, right? The size also as percent of how damaging the disaster was, right? I mean, in history, you have these natural disasters that are devastating, where you have like 2% of the population dying, and you have very little international aid. And today, the number of casualties, at least human casualties, are much lower, and yet you get much larger official lending. So on the finance side, it's less clear. You had these major financial crises also in history that triggered quite drastic GDP collapses as well. But there again, I think the share of the cost covered by the disaster lending or the official lending has also gone up. So yes, what I take away is that it would be nice to have kind of a stylized fact and regression picture of whether the size of this has increased also.
Mm-hmm. May I come in on this? This is Giancarlo. Hello. So fantastic data set, fantastic paper. There are lots of fascinating questions there. So one, if you take the Tirol approach of self-interest solidarity, so basically quantifying the size could shed some light on the amount of damage, collateral damage, spillovers that is taken into account by the donors, right? Which may not be only economical, can also be, you know, a lot of other, could be also solidarity beyond the economic terms, but it could be a fun way to quantify that. And once you do that, there are two issues. The first issue is that anytime you do concessional rates, which is basically you overvalue the ability to pay and avoid a default in the future by the country, usually there is an issue of dilution there. So, you know, if the country then borrow too much, then there is an issue there, because even if you have seniority, there could be a default in any case coming there. And this creates an interesting tension between the objective of these donors, which is to basically jumpstart capital flows again from the private sector, and the fact that you don't want them too many. You want to have like a limit in the borrowing capacity. This is the first thing. So it would be nice to trace over time what happened also to the. I know what you're thinking. It's too much, but let me ask the question. This is the first question. The second question is that Tirol has it only looks at one equilibrium. Unfortunately, we know that there are like lots of multiplicity, you know, and belief-driven market dynamics in this situation. Once you do that, this concession, the amount of money you put in becomes a little bit trickier to determine, because there is an element that is pure liquidity, an element is concessional rate. And I wonder whether, you know, with some case studies, one could learn something. But this again for the next, you know, unfortunately, I would say for the next 10 years of studies, with a lot of more case studies coming in.
Okay. Christoph, if you can in 1 minute, because we are already running out of time.
Okay. Yeah. No. I mean, let me just thank you and say, yeah, I'll take these on board. I mean, I think again, there's a paper to be written, a granular paper on catalytic finance, or you want to call it. So, what is the interaction, the micro interaction, ideally, really loan by loan, bond by bond, both on the official and on the private side, and to understand, you know,
It's fantastic.
Also, looking at primary and secondary market prices and all these things, I think there's room for that, but again, it's not room in this paper. I agree. On the other, yes, I think concession. I mean, shedding light on the concessionality, I think, is something for this paper. So trying to get more information on the interest rates and what the terms are is, I think, needs to be in this one, in a sense, like to understand the full picture and the trends over time. So that one, I think, we hope to bring on board here as well.